I'm Chris Davis. I'm the Director of Investor Programs at a nonprofit organization called Ceres based in Boston. We work with companies and investors of all sizes, shapes, and stripes on sustainable investing. And I'm the Chief of Staff to something called the Investor Network on Climate Risk that is about 120 asset owners and asset managers who are at various places on the spectrum up here on climate change and other sustainability risks and opportunities and integrating them into their day jobs. So without further ado, we have some, let's see. Okay, so this panel, I think we're going to try to be sort of sustainable investing 101 all in about 44 minutes here. And we're also going to talk about some more advanced concepts that are central here. Climate change is an investment issue and fossil-free investing and how that works. So we have really three goals and a very talented panel of true experts who have been pioneers in this field who are going to help elucidate these concepts and answer your questions. So please think of your questions, and in about a half an hour we want to turn to what's on your mind rather than just what's on ours. So our three goals really are defining the sustainable investment space, what it is, how it evolved over the last 20 years, demystifying some of the terminology, concepts, and methods like ESG screening, and then addressing the question of performance, the elephant in the corner. Is sustainable investing, as we'll describe it, consistent with maximizing your risk-adjusted returns and fiduciary duty? Obviously, I think we're going to argue that it is, and there'll be more on those topics as our meeting goes on here. So I'll try to address really quickly some of the what, why, and how with the panel. Let's briefly, I've got a couple of slides here, and I just wanted to, I want to avoid whatever it was, PowerPoint poisoning here, or whatever the bad thing is we're trying to not do. But sustainable investing, at least as we describe it at Ceres, is something like meeting the needs of current beneficiaries or of the institution currently without compromising the needs of future beneficiaries or the institution or the foundation in the long run, with the concept that these are basically perpetual institutions that need to be financially sustainable over the long run to achieve their missions. So it really involves a longer-term perspective than the quarterly or annual capitalism that is rampant on Wall Street and in the financial media. There's been an evolution from negative screening to positive screening and some other strategies. You might hear best in class, integrating environmental, social, and governance factors into the investment process, the risks and the opportunities alongside the financial metrics. These are sometimes called extra financial issues. I'd like to argue that to the extent they're material, that they are core financial issues. They're just harder to measure than some of the financial metrics that typically show up on the Bloomberg terminal, for example. The Bloomberg terminal now has a great resource in terms of ESG data. In addition to the integrating environmental, social, and governance factors into the investment process, sustainable investing involves what is sometimes called asset stewardship, active ownership, or corporate engagement, engaging with the assets, the companies that you own to make sure that they are sustainable and have sustainable strategies over the longer run. And we'd argue that this approach is consistent with fiduciary duty and arguably required to the extent that climate change is a material investment risk that is going to affect the portfolio. How can you ignore it if it has financial impacts and be a responsible fiduciary? I know Keith and his panel are going to talk more about that. And we'd also argue that done well, done thoughtfully, done strategically, there's no trade-off between integrating environmental, social, and governance factors, notably climate change, water scarcity, related issues, into your investment process and achieving robust returns and meeting your targets. So there's some mega trends, again, climate change being the biggest one, that is changing the world and making today and tomorrow a lot different than when a lot of current investment practices were were developed, or the kind of our impact on the world and the world's impact on economic activity is becoming more and more profound. So climate change, population growth, human rights and worker safety, garment factories that make things that some of us wear and that are sold at stores that we shop at, collapsing and killing workers in Bangladesh. That is not sustainable, and it's not responsible. Resource depletion, water scarcity. Our conference is in California next week, the Ceres conference, and we just opened a California office largely focused on water scarcity as a business and an economic risk to the prosperity and the future of California and beyond. Economic globalization, competing for resources, competing for capital, competing for human capital is becoming an increasing factor. And then connectivity and communications. There are no secrets anymore. Everything is instantaneous, over the internet. So transparency is becoming a really important factor. You should assume that whatever you're doing, good or bad, it will become well known, and can very much impact the value of your operation. So climate change as an investment risk and opportunity for companies and investors. What kind of risks does climate change pose? Obviously a physical risk. Think Hurricane Sandy or Katrina, or some of the droughts that are affecting various parts of the world. Sao Paulo, Brazil is running out of water, city of 20 million people. Regulatory risk, as governments respond to climate change, as carbon gets priced, hopefully, this has significant effects on industries, notably the fossil fuel industry, and there'll be winners and losers. Liability and litigation risk, I think we'll probably see more of that. Reputation and competitive risk, if you're not green and your competitors are, not good. Supply chain risk, the big one, stranded asset risk and the carbon bubble that has really driven the divestment movement. Carbon Tracker, Mark Campanelli and his group have brought that to the fore. Water scarcity, water risk, and then really the systemic economic risk of climate change to the entire economy and investment. So Ceres tried to put together what we've learned working with investors over the last more than a decade into something we call the 21st Century Investor Blueprint for Sustainable Investing. There are copies out at the table. I'd encourage you, if you haven't seen it, to take a look at it. We try to describe some of the environmental, social, and governance risks and opportunities that are becoming material, the business case for sustainable investing, how this relates to fiduciary duty, and then try to outline 10 steps that are basically process steps towards sustainable investing. And you don't have to do all of them. You can start anywhere, although starting with investment beliefs and policies is a really good place to start. So let me, without further remarks from me, turn it over to our panel. I'll just introduce them each briefly and then ask them a few questions to tee this up. Each of them is going to make a brief introductory presentation of not more than about 5 minutes. And then we're going to have a few questions among the panel, and then we want to turn it over to you. So think of what your burning questions or comments are as we try to elucidate the history, trends, and effectiveness of sustainable investing. So in the order in which they're going to speak, but not necessarily the order in which they're sitting, Cheryl Smith, Managing Partner and Chief Investment Officer at Trillium Asset Management. Ken Locklin, Managing Director at Impax Asset Management, down there with the striking red tie. And closest to me, Tom Koo, Executive Director at MSCI. So I'll start with an initial question for each of you to try to dig into our topic here. So Cheryl, as a veteran of the sustainable investing, formerly known as socially responsible investing field, could you please provide us sort of an overview of the history and development of this field, how it's evolved to date, and why it's gotten to where it has today?
Sure, Chris. Thank you so much. He's clearly not referring to my gray hair. I must have started when I was 2. But there is a first slide, if you will, which is the flip
Oh,
the slide.
we're going the wrong direction here. That's,
My first slide. There we go.
and I can give you the clicker so you can.
Umbrella there. What I'm trying to do with this slide is just to give you a sense. When people start, I see from where our institution is overlook that we have a lot of people in here that are already involved in the field. But it's very confusing for people that aren't involved. Excuse me. Very confusing for people that aren't involved to look at all the different terminology. ESG refers to environmental, social, and governance. Socially responsible investing. Sustainable investing. Sustainable and responsible investing. Slow money. Intentional endowment. Intentional investing, courtesy of our sponsors here. Divestment. Values-based investing. Community investing. Responsible investing. Mission-based investing. Ethical investing. All of those, it could make your head spin. But the critical part is all of those are terms for people that are trying within what they're doing to incorporate environmental, social, and governance considerations into their investing with an idea of incorporating the impact. As Tony said at the beginning, every investment has an impact. It's just a question of whether you recognize what the impact you're having is and whether you have intentionality as you think about it or you just let the consequences be what they may. Now, we'll see. Everybody's having trouble with it. Ah, great. So here's a timeline of sustainable and responsible investing, and I started this back in the 1900s with religious investors excluding sin stocks. And Mr. Hanley from University of Dayton talked about the incorporation of the values of his institution in it. I'm going to put in a personal note. I actually started in this field in 1986 with the U.S. Catholic Conference of Bishops' letter on the economy, which called for parishes and people to incorporate values into their work and not just be a Sunday churchgoer, but to look at it the whole year. That caused me to change my work. It caused me to change my job. It caused me to leave the University of Denver, where I'd been teaching, and move to the East Coast, getting confused, move to the East Coast and start looking at this investing. But other people were doing it at this time, and I hear that the Pope is preparing an encyclical on this sort of thing now, so we're kind of moving through that era. But early religious investors, excluding sin stocks, the first shareholder advocacy campaign was all the way back in 1966. It was against Kodak. There's also, it's not on this slide, but after the 1968 riots, after the death of Martin Luther King and Bobby Kennedy, you saw insurance companies start to think about where were they investing and moving against redlining and some of the things like that, which I would call a kind of intentional investing and really a precursor to this movement. We had the Sullivan Principles in 1977, looking at divestment in South Africa. My firm was founded in 1982, looking at Sullivan Principles, war, environment, a number of different criteria. In 1986, we had Coca-Cola announcing its withdrawal from South Africa, the first resolution filed by a fund, and the Chernobyl nuclear accident, certainly a big symbol of environmental consequences of what we do. 1990, the Domini Social Index was created. And then we have some areas that are sort of communal action that I've got on here. The Carbon Disclosure Project was launched in 2002. It has $92 trillion in assets underneath it with 750 different signatories. So this is a beginning of really communal action, people working together on carbon issues and carbon plans. The Investor Network on Climate Risk was in 2003, $12 trillion in assets under management with 100 different signatories, followed by 2006, the PRI, Principles of Responsible Investing through the UN, with $34 trillion in assets and 1,232 signatories. So to those institutions and individuals just getting started, I hope that that makes you feel you're not alone in this, that there is a very broad crowd going through it. And then one more development, since I'm doing history here, talking about fiduciary responsibility. There have been a lot of questions. A lot of organizations will say, well, how on earth do I meet my responsibilities to those I have a fiduciary obligation? I don't think I can do this. Well, we've got some comforting news for you, and it's a comforting development through time. Looking back to 1998, the Department of Labor issued a letter, it's known as the Calvert Letter in shorthand now, that said that if everything else is equal, institutions and fiduciaries and retirement plans are allowed to take ESG considerations into consideration and to offer that plan as long as it's the same every other way with risk adjusted. So that is a permissible declaration. In 2005, the firm of Freshfields, and a very long name, Freshfields, Bruckenhouse, blah, 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 blah. It's a law firm in England, did a very large study looking at fiduciary standards across many, many countries. And their conclusion was that integrating environmental, social, and governance factors is clearly permissible and arguably required. So that's a big step from you can do it if everything else is the same. Arguably required and clearly permissible. And then recently, FI 360, which is a producer of guides for fiduciaries, Prudent Standards for Investment Stewards book, said that investment policy statements should define appropriately structured SRI strategies. So we've gone from it's okay, you can do it if maybe you want to and you do it in the dark and nothing else is like that and it's no different than all the others, to you should perhaps do it, to yes, your investment policy statement should reflect your values. It should reflect the mission of the institution. There's nothing in there about how that should do it, but you need to consider the mission of the organization as you do your investment policy statement. So that's your very quick overview.
Thanks, Cheryl. Okay, so Tom, I want to talk about the performance question. Many endowments, foundations, institutional investors, and individuals, including some of us in the room and our financial advisors, have asked the question at one point or other, what are the performance implications? Are we sacrificing returns here in order to save the planet? And there seems to be some prevailing assumption that there's a choice to be made here. Could you talk a little bit about the performance of ESG or sustainable investing and some of the data that's out there that helps answer that question?
Sure. Of course, I'd be happy to. If I said no, it would kind of screw up.
Well, what would you like to talk about?
As long as we're here. A little background. My name is Tom Koo. I work at MSCI, but and have for the past 5 years. Previously, I was with Risk Metrics for about a year. And can people hear? Prior to that, maybe I'll take the. Okay.
There you go.
Thank you. Is this on? Yes? Okay. And prior to that, I was with KLD Research and Analytics for about 16 years. So essentially, for the past, let's call it 20 plus years, because I can't add, I've been looking at performance issues. MSCI, for those of you who are not familiar with the company, is a publicly traded company, market cap of about $7 billion, and we essentially do three things. One is stock market indexes, second is risk management, the third is ESG research. And the indexes have roughly $9 trillion benchmarked to them, which makes MSCI sort of a critical linchpin in the financial system because we live in a very benchmark-driven world. The ESG research unit we have has about 200 people whose work I live off of, basically, in doing the ESG indexes. As Chris mentioned, performance questions are always brought up in the context of this conversation. So it's the elephant in the middle of the room, not in the corner of the room, frankly. And they've been persistent as long as I've been doing this kind of business. The first benchmark created in this in this area was referenced by Cheryl. It was the Domini 400 Social Index. It's now the MSCI KLD 400 Social Index. It's notable because on May 1st it passed its 25th anniversary, and it has provided a stream of sort of live risk return information that has been critical in the study of performance in this area over that period. So today I'm going to do two things. One is sort of take a quick look at the literature on performance, and then look at a few benchmarks. And I decided to provide different benchmarks representing a range of ESG strategies, but also covering different geographical and regional areas. I would be remiss, because I forgot to put this on the slide, which means it didn't really go past our legal department, to mention that past performance is no guarantee of future performance. It'll be on the copy you get. But it's not only a standard disclaimer. In fact, it's true. So, with that in mind, if let's see, where's the?
You have it right there.
I have it right here. All right, great.
Not enough hands.
Not enough hands. Okay, so.
The one to the right. Here. That. Yeah, there you go.
There we go. Okay. All right. What I've put up here really references the academic and practitioner literature, the prevailing view coming out of it. These are studies from Deutsche Bank, Mercer, on behalf of CalPERS, the middle one, and the bottom one from RCM, which is an investment management company. I highlighted certain conclusions. The first two are meta-studies, which means they're studies of the existing literature and essentially taking a view of the entire landscape in this regard. And they come to a very consistent conclusion, which is that there's no necessary reason to expect underperformance from using ESG criteria, and there's some reason to expect it may benefit performance. And I think that's really critical. It doesn't mean there aren't studies out there which show in a particular period with a particular strategy that things may have underperformed. What it means is that overall there is no reason to be concerned about putting ESG considerations into your investment policy statement and into your investments, and I think that that's critically important. So next, I just want to go through, if you will, a series of performance slides on different benchmarks that we have. These are several out of the 140 or 50 indexes we have. This is the MSCI KLD 400. It is what we would call an SRI index in the sense that it excludes a number of companies involved in things like alcohol, tobacco, gambling, nuclear power, and so on, and at the same time selects companies that have good sustainability records. And what you can see is, and I've highlighted on each of these slides sort of the right-hand side of the performance table showing the longer-term performance. What you can see is that the performance over the lifetime of this index, this is the full 25-year history, has been positive in terms of reference to its benchmark. And I believe, although we're not in a position to benchmark to the S&P 500, which is often compared to, that the performance difference for that index is even larger. This next slide, and I cannot read that far. Sorry, I can't see that far. This takes the MSCI ACWI. When you work for a company that whose name is an acronym, you like acronyms. And ACWI is the All-Country World Index, developed in emerging markets, large and mid-cap companies. I took the ex-USA version because we just looked at U.S. performance with the KLD 400. This track record goes back to 2007, so it's not as long. It's a sustainability index, so it doesn't have the screens, but it is based solely on the selecting companies with high sustainability ratings in a way that's sector and region neutral. And again, you see that it's outperformed over the long term. Thank you, Cheryl. And I can't even tell if I'm on the next slide.
The slides will be made available. I know they're hard to see, right, and the setup isn't.
Is this ACWI low carbon? Yes, okay, thanks. So recently we've launched a couple of indexes which I think are very germane to the carbon asset risk question that's on the agenda here. One is a low carbon strategy. another which is an ex-fossil fuels. The low carbon strategy is designed to reduce exposure to carbon reserves intensity and carbon emissions intensity. In this case, again, looking at the global level, you get a 77% reduction in carbon emissions intensity, 95% reduction in carbon reserves intensity. It tracks very closely to the underlying market, and as you can see over the brief period we have for the live and simulated track record, it tracks as it's expected to very closely to the market. This last one is an ex-fossil fuels index. Thanks. It's an ex-fossil fuels index. It excludes the owners of oil, gas, and coal reserves, which represents today about 7% of a global index like ACWI. And you see that particularly in the recent period, it's actually benefited quite directly from the falling and low energy prices. This is a good time not to be in fossil fuel companies. Whether or not long-term that's the case, I think, is an open question, but I think it's important to recognize that it does offer it certainly offers a case that there may be some benefits to being out of fossil fuels. And we've done longer-term studies, some of which are posted on the website that look at this. I just want to wrap up with a couple of conclusions here. One is that I haven't talked about risk here. I've just talked about performance. But on a risk-adjusted basis, all of the reason I didn't is because on a risk-adjusted basis, all of these strategies also outperform. The second is this is indicative. There are clear trends. And I think that what's really important is that this should help address the fiduciary concern that is often thrown up, I think, largely reflexively, and I think sometimes as a smokescreen to inhibit people from going down this path. And I think that the performance question really should not be a barrier in that regard. And so I think what I'll do is stop there, and certainly if there are further questions or people want to go deeper into this, we can talk about it later on. Thank you.
Thanks, Tom. Now, Ken, so climate change, which we've touched on already, which is probably what brought many of us here, has been described as the mother of all ESG issues in terms of risks and also emerging opportunities. There's been much attention to divestment of fossil fuel stocks. Could you please talk about your firm's and others' analysis of the performance of fossil-free investing? And we'll get to the opportunity question later.
Okay. I just want to check. Do you want to see if the lavalier is working on me? Yes. Fine? Great. Okay. I know I don't have enough hands for that. So first of all, most importantly, I want to apologize for ignoring 2/3 of you all the time while I'm talking. I can't do anything about that. My neck is not supple enough to do that swing, or I'll pass out. So, you know, it's nothing personal. Ask me a question afterwards. Impax Asset Management, I had a really nice, beautiful, look at this. See this slide? It's really pretty. That's us. They took it out. It didn't match, Barbara, come on. It didn't match the theme. Anyway, it's a sunrise. That's who we are. That's what we're all about. So we are an 18-year-old London-based asset management firm. We manage a variety of different kinds of equity portfolios. Since the organization was founded, it has only invested in climate solutions. That was our goal and orientation from the outset. We manage a little under $5 billion now in 23 funds worldwide. All of them are fossil-free and have been since inception, because we invest in a universe that simply doesn't include fossil fuel companies. So don't ask me what I think about Exxon, because except for the fact I use the gas, I do not know. The slide that's up there is a way to think about, in a very standard textbook kind of fashion, the supply and demand curves for, we're going to say, a fossil fuel. It's notional, obviously. So it could be the oil curve, the gas curve, the coal curve. It could be the curve for the availability of mustard seed. They're all the same structurally, but it's a very simple concept. And you can see, for those of you who are close enough to see the dashed lines, the P0 and V0 dashed lines, to the right of that are some assets, notional assets. Each bar is a different asset, like a different location for drilling for oil, for example. To the right of that are some bars which are too expensive to be in the market at a given point in time. So all the bars to the right of the V0 position are out of the market in whatever today's price is. This is stuff we all saw in college. Now, this is the challenging slide. It's a little busy. So I'm not going to spend the time this deserves because they wouldn't give me the time. So, you know, again, talk to Barbara. It's not my fault. What we're talking about here is what happens when that cost moves over time. So the dashed line is a new line at the dashed line at the top above the solid line going from upper right to lower left is a new line which represents what happens when there is an incremental price on carbon. And when that line shifts up and to the left, you automatically wind up as a consumer paying more for the products you buy. And as from a wholesale perspective, there are some assets that you can no longer reach. They're out of the money because the costs at which you can retrieve the assets, pay the cost of carbon and sell the assets don't allow you to operate in that band anymore. Nobody argues that there is such a thing as stranded assets. The only way there aren't stranded assets is if markets are. This is very nervous-making, Bob. Don't do me a favor. Don't look out from behind that gentleman's head because I do not want to be saying his thank you stuff in front of you. When you have card-carrying economists in the room, it makes you very nervous if you're an investor. So the impacts are clear, though. If you believed that there were going to be such a movement and there would be some form of price associated with carbon at some point in the future, at any point in the future, you'll see these movements. These things will happen. You will see assets stranded, may not matter, could be too far out. All the current ones might have been expended by then and all the dirt would have fallen in and there wouldn't, anyway. But some assets will be stranded, says economic theory, and there will be a spurring of interest in things to reduce demand or provide alternate ways of generating energy. I live in Washington, D.C. I know there will not be a carbon tax in the current Congress. Most people, many investors, will take that as an excuse to do nothing in the current environment. We don't think that makes sense. It seems to us that if you are, for example, and I know this from friends in the industry, if you're a coal investor, the EPA regulation on mercury emissions moved that line up and to the left. All of a sudden, it became more expensive for you to do business. That law was passed. It's already passed its legislative challenges bar one, and it's judicial challenges bar one. It's not likely to be impaired at any stage going forward. The same thing happens to you if you are impacted by the Clean Power Plan, which the EPA has offered. If you're a coal industry and Section 111D of the Clean Power Plan is rolled out, you will be out of the money. A significant part of what you do will no longer be cost effective. It's just a fact. No hard feelings. These things happen, unless you're holding the assets. It's also possible that you could look at the level of allowable vehicle efficiency and see mandated changes from the government forcing you to make more fuel-efficient cars. That also has the effect of changing the de facto price because of the way the structure is set. And again, that regulation comes in two parts. The first part is now 3 years old. It's working exactly as planned. The second part is working its way through the regulatory process now. So these things are happening. We argue, therefore, that carbon asset risk is real, and it's happening now. And if you're a manager, you have to pay attention to it. The reason you have to pay attention to it, if you're a financial manager, is that managers, and Bob is actually a great example, is managers manage risk. That's what they're paid to do. What managers can't do is manage uncertainty. If they don't know if there'll ever be a de facto cost on carbon incremental, if they don't know if that will ever happen, and there's no way they can know, it's hard to make a decision. If they know that there is a likelihood there will be a cost, and the only question is time, that's a risk. And financial people are supposed to be managing risks just like that all the time. So how can you manage a risk like that? The simplest way is the way that Ellen would recommend, and that's you divest of all of your fossil fuel-related industry holdings. This is a graph, actually, which tracks, it's not Tom's information, although we use Tom's information in our own internal work. This is a study prepared by Advisor Partners. It's there because it is the longest-lived study that is effectively a comparison of an ex-fossil fuel index and the broader market. again, we're just talking about listed equities here. You can't see the difference between the two lines. That's the point. 25 years. That's a long time. The studies that have gone longer than that have tended to show such a perturbation of the broader economic system. One was done a little while ago, showed was a 100-year cycle. Literally buggy whips were included in that study as one of the industrial sectors. I mean, it's not relevant. This is relevant today. So you can divest. Ellen thinks it makes sense. There's no reason to suggest it's going to cost you money in this sector from a historical perspective. But there are investors who are anxious about that. They feel that that is not the way they want to move. There are other investors who say, I don't have to divest now because I can, and the macho investment industry says, I can catch the falling knife. You know, I'll know when to get out. People who say that need to look at the experience of the U.S. investment community and its holdings on coal companies. Coal company stocks tanked over the last 3 years for very obvious reasons related to a significant degree to what we're describing right here. I know one organization that did very well when that took place, Ellen and the Wallace Global Fund. They are clever, but not because they were clever, not because Tom Van Dyke has advised them correctly, but because they had left the sector. They were gone from fossil fuels, so they weren't impacted. Their stocks and investments have been redeployed. So if you think you can catch a falling knife, good luck with that. If your advisor tells you that, find a new advisor. So I think that I'm going to stop here and then talk a little more about the breadth of the opportunities when we get to that stage.
Sure. So how are we doing on time? We're a little behind here. About 10 minutes. Okay. Why don't we just do a couple more quick questions, very quick, and then please be thinking of viewers. I guess this is for all the panelists. What trends are you seeing in the market regarding sustainable investing, regarding investing in solutions to climate change or avoiding climate risk through fossil fuels? And what are you hearing from your clients? What are they asking for? Are you seeing any recent changes here?
Can I start with that since I have a slide up? And then
Sure.
Go back this way now?
Sure.
I'll never get back.
Maybe we'll come the other way here.
I'll never get back. Exactly. So, what are we hearing? We have clients who are coming to us and saying, I'm not prepared to invest my entire portfolio, but what am I going to do? I have this concern. And they have two major options. They can hedge their investment. We're not allowed to say bets, but they can hedge their bets by diversifying their portfolio away from the concentration, which might be 8 or 10% in fossil fuel exposed industries right now, if it's a typical portfolio. Or they can invest in solutions. And that's the reinvest, the divest, reinvest part of the work that Ellen is leading. And some companies do both. They will hedge, they'll reduce their exposure, and they'll invest in solutions. And the way that we do that is to look at an investable universe, which is quite broad, and I'm going to go very quickly through it here. We invest across a fairly wide subsection of the global economy. It's a small percentage of the global stock market, but it nevertheless represents the markets fairly effectively. From a performance point of view, we invest in energy efficiency, alternative energy. Somebody pointed out to us the other day, with the current growth in that market, it's not fair to call it alternative anymore. There were more alternative energy investments made in the United States than there were fossil fuel investments made last year by dollar. We also invest, we invest in the water infrastructure, critical interplay between water and energy, and we'll do that offline. We invest somewhat more obviously in the resource recovery, recycling, very energy intensive energy recovering business, and we also invest in the sustainable agriculture business. Very important from an energy perspective. So we can talk about details of that later. How's that going? Here's the graph that I think helps people understand the broader opportunities. These are 3 indices. The bottom one is the standard, most commonly quoted renewable energy index. It's been volatile. It's a tough market in which to invest, frankly. To buy the market and hold it has not done you a lot of good, honestly, in the last 10 years. I tried to buy that index when it was launched, and one of the people who launched it begged me not to, and he was right. The next lineup is the broader market. It's actually Tom's MSCI All Country World Index. That's what the market has done, the dashed line. The top line is the index, not our performance, but the index of all of those subsectors that I presented to you, about 28 subsectors over the last decade. We've done just fine. As an industry, this sector has done just fine. We like to think that that divergence out in the last couple of years is going to continue. We sure can't promise that. But if you look at the broader impacts of the market and the kinds of social and political movements we're dealing with across the country, it's hard to bet that that trend is going to reverse.
Okay, Cheryl, so same question. For who are the clients that you serve, and what are you hearing from them in this space?
Sure. The clients that we serve are a range of high net worth individuals, foundations, some educational institutions, faith-based institutions, so a really wide spectrum. Most of the clients that come to us know we have a long history of including sustainability. It's the only thing that we do, so people are interested in a broad range. But what we find interesting is we are seeing organizations coming to us, institutions coming to us, who had not been investing in sustainability. They're coming as a result of the dialogue on carbon, the dialogue on investing, divesting, and they are saying it is an opportunity to include not just what do we do with a carbon economy, but what do we do with issues of justice? What do we do with issues of employee concerns? What do we do about supply chain? How do we move across that entire spectrum? And how do we get that alignment between what our mission is, what our goals are as an institution, and how that's incorporated in our investment practice? How do you help us do that? So we find investors coming to us, they are of a range of approaches on the specific fossil fuel indices. All of our products are more divested than most of the companies that are not, that most of the organizations that have said that they're divested. We haven't invested in tar sands, we haven't invested in coal, we haven't invested in a wide variety of things. Those are our non-divested products, are not invested in those. But we find people saying some organizations really want to get involved in the engagement because they think through the dialogue, through the conversation, through pushing other organizations or other companies, they're going to get more progress on a lower carbon economy. So our engagement is not just with oil companies, not just with gas companies. We also engage with companies that just have large operations, and how do they get better energy efficiency across all of their operations? If you're a Target, if you're a Walmart, if you are a large manufacturing company, how do you incorporate sustainability goals into what you do? So there's huge ranges for dialogue that go well beyond the getting Exxon to stop producing oil. I personally think asking Exxon to stop producing oil, I don't like beating my head on brick walls. I don't think it's very effective. I don't think that one's going to be effective. But asking other companies to alter the demand side of it can be very, very powerful in moving to a lower carbon economy. So we're seeing a lot of clients interested in that, a lot of environmental organizations finally coming and saying, the light has gone off. It doesn't make sense to invest all my investments against what we're trying to do with our mission. So we see a lot of organizations really waking up to the how do I align the investments and the mission.
Okay, real quick, and then we're going to open it to all of you. Tom, who are your clients and what are they asking you for in the last year?
Okay, our clients are asset managers, asset owners, and consultants. So the full spectrum of basically the investment value chain. I would just give a very simple answer here, which is CTI plus 350 equals a conversation on carbon asset risk that has basically gone from a murmur a year ago to a sort of steadily rising crescendo. It is a conversation that is on the minds of virtually every college and university endowment that we talk to, many public pension funds, and many foundations and endowments as well.
And how's the uptake of those two low carbon indexes that you talked about?
The low carbon index I referenced got picked up by for ETFs by Barclays and State Street, and we've got institutional accounts but not public funds available on the ex-fossil fuel indexes.
But it's moving very rapidly. So